Okay, very good morning. Thursday the 9th of March. Let's get the briefing underway. And actually quite a few different topics to touch upon in today's briefing. And then of course today is the ECB interest rate decision. And as per usual, the press conference then with Mario Draghi. So we'll also have a quick run through of that before we cover that in more detail closer to the event. But coming out with a few stats to start with. We had that big fall in WTI crude yesterday, so despite the brief rally that we had when the numbers originally came out, we actually saw on an intraday basis, this was the biggest fall in crude oil in over a year, with a fall of over 5.5%. So we had that brief kind of the fact that there was a build, but not quite as big as what would happen last night or the night before in the APIs. The gasoline as well was a larger drawdown. We saw it shot higher, not quite as bearish, and then all of a sudden it kind of took hold. People started to focus on the overall global supply issue in addition to the ramping up of US output, and that contributed to a break all the way down to pretty much test a $50 handle. We'll have a talk about that in a bit more detail in a second, but let's just have a quick look across the broader asset classes. That meant then that Wall Street was a lower close once again. I think this is now like the third day in a row, and it's the first time that's happened in quite a while. Well, actually, in terms of the S&P, that's now fallen for 5 days in a row. That making the biggest 5-day fall since the 4th of November of 2016, so obviously just before the US elections. So we continue to see a little bit of just hesitation after the all-time record highs that were breached not so long ago, when we of course surmounted that 21,000 mark and then that 2,400 tested in the Dow and S&P respectively. Elsewhere, gold as well has been continuing to come under some pressure. This morning we're down again about $5, and if you start looking on the weekly chart, after we started really 2017 really on the front foot for gold, and we actually had 4 consecutive up weeks up until the last 2 weeks, until we've had this quite significant and quick pullback to the 1200 handle after we had breached 1250 not that long ago. Obviously gold play in tandem with the rising US yields on the back of this change, this real definitive change that we've had in sentiment, in Fed communication, prepping the market for that March action. That certainly wasn't the case as we were going through mid-late February, when we were still rallying on gold, when that was really the height of, at the time, the French political concerns really came to the forefront for the first time. And it was almost as if the market wasn't really positioned correctly for that. We saw the movement in French yields, the spreads moved wider, and so on. But since that situation has somewhat steadied, at least for the moment, and the Fed have taken the front seat and being the main driver of the market, we've seen gold seeing a pretty quick and substantial pullback of well over $50 in less than, well, really a week and a half or so. Cable, pretty steady this morning. We found a bit of resistance around pivot. You can see the top of my charts on the initial test so far. Likewise, Eurodollar on the pivot level upside. Cable, though, had its 9th, I think it was, consecutive down day yesterday. I think if we continue to have consecutive down days from here beyond, you're going to have to go back a number of years before that was the case. Obviously, we had that, irrespective of the fact the budget yesterday, we did see a brief rally on the back of that around the same sort of time. We did see a bit of movement upward on the growth expectations for this year, but overall for the subsequent years thereafter, not quite so positive. Euro wise, I guess this is a little bit of maybe the dollar still sitting around its most elevated levels, but a bit of profit taking just off the highs this morning, I think, more than anything, and hence both pairs just seeing a slight bit of upward movement really as Europe's come into the market. Equities fairly quiet. I mean, the S&P is flat, slight negative trade in the European bourses just on the back of a lower close on Wall Street, and overall negative, I'd say, in terms of Asia, albeit moderately, And in terms of yields, we continue to move higher. You've got bunds down 23 ticks already, T-notes down 7. Not only have you got the Fed being very hawkish, 100% priced in now for March action, market now pre-positioning itself for the path of rates thereafter and the tone that we could hear from the Fed, ultimately the risk being more hawkish than not, i.e. that they're going to follow then their trajectory of 3 for this year, if not possibly more. And so this is prompting the market to then look forward and reprice accordingly. And in the bunds, or bund futures down 23 ticks. Again, this is also a bit of a byproduct, I guess, of looking forward to the ECB interest rate decision, where, as you'll see when we start talking about that in a second in more detail, everyone's kind of suggesting, I wouldn't say hawkish, but more a slight move away from their dovish, more accommodative stance that we've been so used to for such a long time, which of course is the beginning, if you like, of the next step of policy reversal in terms of the European Central Bank. So let's get underway then with a couple of charts and graphics I want to share with you, and it'll put some of the market moves, I think, in a bit more context, and got a good spread of different assets and topics to discuss this morning. So firstly, starting off with China, overnight, Chinese producer price growth has hit 8-year high as early spring depresses consumer inflation. So what you're seeing here is a really big divergence between producer prices and consumer prices. You can see the CPI measure moving back really towards 0, whereas an 8-year high here coming towards 8% in producer prices in China. That's phenomenally high. This chart doesn't actually go back far enough, but the last time we were up this high in the PPI number, you would have to go back to the Beijing Olympics. So going back to 2008 was the last time, the run up to that, when that was really ramping up on that kind of one-off event, if you like, in preparation of that. The reason why CPI has fallen, though, essentially is actually down to, in large part, the weather and changing weather patterns. What I mean by this is that consumer inflation softened markedly thanks to a surprise bumper crop of fresh vegetables spurred to growth by unseasonably warm weather. So, quite interesting to note in terms of the underlying drivers of what really pushes these inflation metrics and the difference between them. A couple of interesting other stats. It was the 6th straight month of expansion for China's producer price index, so I don't think the market's getting overtly worried about that situation. It's the fastest pace since September 2008. Most economists expect this to peak and peter off in the coming months ahead. So in a bit more detail, the Stats Bureau in China chalked a slight month-on-month deflation up to a fall in food prices, particularly vegetables, so growth of which was benefiting from unusually warm temperatures across the country last month. Also as well, don't forget, this data is encompassing the Chinese New Year, so as well as a depression then in travel prices during the post-Lunar New Year period. It attributed the year-on-year softening of inflation to elevated pork and fresh vegetable prices last February, resulting from a cold snap in early 2016, combined with that unexpected boost to fresh vegetable stocks last month. So again, seasonal pattern changes in average temperatures having then a knock-on effect on harvests or food, I should say, and then that explains the weakness here in comparison to the PPI number that you're seeing. Elsewhere, we talked about gold just a few minutes ago and saying how quickly it's reversed course here in the last 2 weeks or so. Gold really feeling the strain of the changing of positioning from Fed communication to really bed in and cement a March hike. Don't forget, realistically, it was probably about a week and a half ago we were priced at 40%. We're now all the way up to 100% for the March move. And this is really the predominant reason of why I'm showing you this slide. This is basically overlaying Treasury 10-year bond yields in the US in white and the correlation inverse at the moment with spot gold. So if you were looking to trade gold from a more macro fundamental point of view, what you're basically looking for is the Fed decision on the 15th is very important for that trade, because March is pretty much a done deal, but it's what hint or nod do we get in toward their assessment of the period going thereafter, i.e. can we make an assumption about when the next interest rate hike might come and how many hikes there will be thereafter in the year as a whole. That will then determine how much US yields will need to move. And by that then, the higher this moves, more pressure you would think goes onto gold prices, also as well obviously the dollar tracking the yield movement, and if that firms up, also traditionally an inverse relationship. Technically, obviously gold sitting around close to 1200 again. It's found a bit of support this morning around that S1 level for the time being, but just given the way that gold has been, especially yesterday, the severity of the fall, fairly aggressive in nature, I wouldn't be surprised to see 1200 at least tested today at some point. You would imagine there would be a little bit of defense around that figure. However, a break of that, you've got the S2 sitting just below about $1, could then accentuate the move to the downside if some stops get run, and so on and so forth. So keeping an eye on gold. We're only about $4 from the handle at the moment at 1200, which is always acts as a bit of a barrier, so to speak. Okay, next up, let's have a look at crude oil. Now, let's just have a look at the chart first, and then we'll look at that in a bit more detail. But what you're looking at here is 30-minute candlesticks. So the first initial reaction that we saw was the data came out. This was the Department of Energy's crude oil inventories, and we rallied. Now, we discussed that at the time. That was because the bar was set pretty high in terms of a bearish report. And by that, I mean that the API crude oil inventories was a build of in excess of 11 million on the headline. So one of the biggest numbers statistically that we've ever really had. So when the data came out, we were talking about the way that the market was positioned. We were already down roughly $1 since when the API came out. So the market was already expecting that to be a build. The only thing was that the build was not quite as big. It was about 8 million rather than 11. And as such, that with a bigger drawdown in gasoline saw WTI initially move higher, and we retraced pretty much to the highs that were seen in the overnight Asia Pac session and early European trade. Then we had a really dramatic turnaround. And when we broke the earlier highs that were seen in the early part of the US afternoon, we then broke 52, the respective S2 handle, and it just capitulated to the downside and really aggressive selling. Likelihood, a lot of momentum behind this move, triggering further participation into the kind of decline, if you like, and then it was almost self-fulfilling. It just continued to get hit through 51. You can see just sub 51. Likelihood just hitting a lot of orders there as well, and then another big powerful move to the downside just ahead of the eventual, what would have been the traditional close, which would be at 7:30. We've kind of stabilized more recently, but quite interesting to see when the market kind of hits it like that in that kind of aggressive fashion, that it kind of pushes the price to its most logical point. And this quite often happens. The market tends to target big round figures into a point of exit when you're trading in that fast money type price movement. And so $50 was obviously the target there, and people just coming out of that. And then you get the big wick kind of bounce, if you like. You know, that looks small in comparison to the move, but that was about a 50-cent snap back up in the accompanying half an hour or so. This move, though, in its entirety, if we measure it up from, well, really the high, let's say, of where the spike was on the data to the low, you're looking about roughly 5.3%. And actually, that's the biggest one-day downward move that we've had in WTI crude here in over 1 year. Now, why has this happened, and why did the market look at this later and decide to push it lower so aggressively? So a couple things that we need to be looking at. One is that you've of course been hearing OPEC being very vocal about the idea that they're being compliant. And this is very important because we've talked about this before. The history of OPEC is that they're not compliant at all, is what history tells us. They have predefined quotas, but very rarely do they actually stick to that. But at the moment, and for the last few weeks, they've been very forthcoming in saying that they are complying to rates of over 90% in some cases. And in cases of countries like Saudi Arabia, they're even going beyond that of what they've been asked to do in that OPEC accord at the end of November. Irrespective of that fact, though, what we're having is that US commercial crude stocks, which is the white line, continue to mount, and at a very aggressive rate. And US production continues to go up. So US oil inventories keep rising despite OPEC's efforts. OPEC stepping up this is to try and, if you like, counter, or you want to alleviate the overall glut in the market. But with US crude production also on the rise as well, US crude stocks keep building. If you remember, we've had the previous 2 weeks have been relatively small, kind of 1 to 2 million builds. But the weeks prior to that, we were seeing builds of 12 million, 9 million, 14 million, very sizable. And this is making life particularly awkward for OPEC in order to have any influence of trying to move this price. The one thing you would think that is when we get down to around the $50 level, is that the more we get towards these lower bounds of some of the price action that we've had more recently, the more vocal they'll probably become about taking action when the existing deal expires in the summer. That would not be a surprising headline to hear either directly or from a market source at some point today, which could provide blips of price activity to the upside. Something along the lines of, we are willing to start discussing now about an accord to cut production further in the summer. Something like that would not be too surprising and something to keep an eye out for today. Along that similar line then, what you're already starting to see is a little bit of pre-positioning of that, is that Saudi Arabia and Russia offer a united front on oil supply cuts. So obviously it's in the best interest of both if prices remain more elevated rather than continue to push lower. And the Saudi energy minister has acknowledged that global crude inventories are not draining as quickly as he has expected, opening the door for an extension of production cuts into the second half of the year. That, as well, in combination with the fact that Russia are being more cooperative as well with OPEC nations, is a sign that they want to verbally almost intervene to prop this price up. So keep an eye on that for sure. A few things that will make a bit more sense as well of why the market is getting, or that it moved the way it did yesterday, was that this is a chart I saw last night, which was US oil rig counts, which you can see in the green, which has been on a steady incline, and then US crude production. And what's quite interesting here is when we were seeing the decline around, this, if you think about this being on the right on the left, was the beginning of 2016. What did you have at the beginning of 2016? You had the real uncertainty about a potential hard landing in China amid the liberalization or pursuit of that, the devaluation of their currency and so on and so forth. That caused then a general concern in the global financial markets and saw growth estimates globally decline. Likewise then the demand for the crude fell, and we saw this tracking lower. You then, of course, had Brexit in that summer, and that was kind of when we hit the bottom, if you like. Since then, though, the US economy has started to come back and perform and improve and recover. So US oil rig counts have started to go on the incline as well. US crude oil production, though, you can see here, this is a fairly tight correlation when it was declining, but this more recent path, you can see US crude oil production is moving away from the oil rig count, i.e., even though this pace is slower, the amount of production coming out of these rigs is improving, i.e. they're squeezing more performance out of the rigs that they have. Now, before I get into the reason for that, looking at where US oil output is at the moment, because that was a very telling statistic that we had in the oil inventories yesterday. I think it was up 0.72%, if I remember correctly, for the US output number. Now that was almost double the prior week, and it's not very often that you see a percentage number quite that high. I would say US output tends to fluctuate between 0.2, 0.3% on a normal basis, but we were up with an increase of US output over that measured week period of 0.72%. Now where does that put us? That puts us at 9.088 million barrels per day. If you look where that puts us in the grander scheme of things, we were at the peak, which is probably looking at around, well, if you look at beginning of 2016, we're pretty much at around those levels. That was around 9.2 million. But then if we go up to the peak, we start getting up towards 9.6. How long will it be until we get to 10 million? Which not only would be a record high, as you can see here, this goes all the way back to 1980. But if we get to those sorts of levels and above 9.9, US will in fact be producing more than Saudi Arabia. And that's quite a frightening thought for OPEC for sure. This push for lesser dependence on the Middle East, making America great again, increasing self-dependence on their own supply of crude, and also boosted by the fact that the economy is improving, there's this fiscal element coming in, and also if you break that down on a more micro level, Trump in particular looking to deregulate or make licensing more easier for US firms to drill and so on and so forth. Most consensus is that this number will continue to rise at the pace it has been rising. And if that happens, you're looking at around 2018, then we could be pumping more than Saudi Arabia in the US. And therefore, does the power or the influence and balance of power shift for the first time ever out of OPEC's hands? Because now, not only have you got the Russia situation, where they're the top current world producer, you then got the US coming, full head of steam behind them, and Saudi have got to drop now down to third in the pecking order. Makes a bit of sense then why Saudi are looking to IPO part of Saudi Aramco, their kind of golden goose if you like, and why they're going to the bond market for financing. The situation has changed quite quickly in regards to Saudi Arabia and their previous dominance. Why is the US becoming so potent? Well, this is a slide that I shared with you guys before, but just quickly for those who haven't seen it, it might make a bit more sense now if we recap it. But what we're looking at here on the left, if I go over that first, this was the start of January 2012, right here, down at the bottom of this, let's call it the snake. So the return of the Nokia 3210 last week. It's quite a familiar pattern. So 1,200 rigs, this is the most important thing, the US oil rig count. Now, if you compare that to the amount of rigs that were in operation at the beginning of January of 2017, that was more like 400. There's been a dramatic fall in the amount of US oil rigs. What this chart though is explaining is that if you follow the path along, the left hand side, i.e. the higher this path goes, equals more US onshore crude oil production per day by the million. So here we had 1,200 rig counts and we were producing just over 4 million barrels per day. As we've gone up, productivity has improved. Then you've had November 2014. OPEC declines to cut output and prices plunge. This was really the main part of the OPEC strategy of when prices were down, really this time last year I guess, when we were looking at $26 in WTI crude. This was because OPEC were steadfast that they would not cut output, therefore keeping the supply hitting the market in order to drive the price lower, because remember we were in a period of the market through China and Brexit, global economy slowing, less demand, supply still coming, the price moving lower. The objective here was to destroy the shale industry, put them out of business, get the price of crude oil to a point where it's no longer feasible for these US firms to run those facilities. The oil price plunged. Therefore, the response of this was that US rig counts had to be closed. and then we see a dramatic move to the left. So we fall from almost 1,300, 1,400 rig count all the way down to here. US onshore crude oil production reaches a peak at 7.7 million barrels a day, but we drop to about 700. Then as we've gone through the China crisis, 2016, rig counts declined to their lowest amount, which was around 350-ish, before then steadying at the beginning of this year. Now the interesting thing here is that although we only have around, going off the beginning of the year, just over 400 rigs, those 400 rigs are producing, on this graph, roughly about 6.6, 6.7 million barrels per day. If you look back to 2012, we were only producing about 4.2 million from 1,200 rigs. So what that's telling you then is that we're getting much more per rig than we've ever done in history. So between the period of 4 or 5 years, essentially technology, development of the shale industry, productivity has gone through the roof. And now, with many fewer rigs, we're getting much more higher productivity. Why has that happened? Well, this makes a bit of more sense here. And if I just flick back to this chart, just to quickly show you. So this in essence is shale oil. I'm not going to dwell on it too long, but this is how the facility looks. You basically are drilling down and then going across laterally. And then it's through the extraction then of seismic explosions to then generate that movement that creates then shale, or the extraction of it. What's happening here is that US shale oil wells are getting bigger and drilling faster. So that lateral length we just talked about, so when you go down and across, essentially from 2010 to 2016, the length has improved by almost a third, if you like. So that's where the productivity per rig is coming from. And if you look at the drilling time, actually from 2010 to 2016, it used to take about roughly 50 days. Now it can be done in 20. So the flexibility in order of the US shale market to respond to fluctuations in prices is now much more effective and efficient now than it's ever been, through the advent of better technology. So hopefully that explains a little bit more why US output, if we go back to that graph then that we were just looking at, that's why you're starting to see this divergence. And if this rig count continues to incline, which is likely to be the case under an improving domestic economy, then this crude oil production keeps tracking higher. 10 million should be seen in the not too distant future. And if that happens, it's going to be interesting to see what OPEC can do in order to counter an impending further decline in WTI crude. The likelihood is they're going to have to do more in terms of output cuts. And certainly I'd be expecting, if we break 50 today, you're going to get oil ministers start being fairly vocal to verbally intervene in the market. Okay, quickly then, a look at the ECB. Obviously Mario Draghi here, not very often you see him smile. This is his regular face, and the face you're likely to see this afternoon. The key thing here with the ECB today is more to do with not, I would say, being hawkish, but it's the beginning of an end of the era, I would say, or it's coming to, of continued QE, negative interest rates, liquidity operations through those targeted long-term refinancing operations. What we're probably going to hear today from the ECB is subtle hints towards a very gradual, a very slow change from being highly accommodative policy and the removal or reversal out of that. One of the biggest things that the market's been looking at, as the headline denotes here, is inflation. That's really what might force the ECB to change tact slightly. And after, if you were to look at Eurozone inflation on a chart, basically it's done absolutely nothing for an extended period of time, and only recently it's essentially just ramped up. And that has brought about concerns from the hawkish contingent of the ECB, which of course is Germany, for one. Now, one of the important things about today is that the ECB are going to be releasing their latest projections, which the market's going to be looking at closely as to how do they see inflation panning out going forward. So a quick run through this article because it highlights a couple of interesting things. In the months ahead, Draghi has used his opening statement to say that if the economy worsens, the ECB could cut rates further or increase the rate of bond buying beyond the current 60 billion a month. And until now, those remarks have not mentioned the conditions for pulling back support. Remember, this is a difference. Now we've had this quite dramatic change in inflation, which has started to rise across the Eurozone, and in particular in Germany, is that never before has Draghi really had to encounter the issue. Before, it's been about how much more are we going to do? You could define the move from 80 to 60 billion purchase of bonds per month as a slight taper, but ultimately the program is even bigger because the timeline was extended from the ending in September to the end of 2017. So the proportionate amount of bonds bought is actually more. But price pressures are rising and the recovery broadening. The hawks believe that the time has come for the president to drop the doom and gloom. So this is looking at this chart here on Eurozone inflation is the ECB's target level for the first time in 4 years. So much like the mandate of other central banks, the Bank of England, obviously inflation is at around that point now and expected to go above. The Fed, the reason why they're now more happy to be full board hawkish for pricing in March is because their core PCE measure likewise has been on the rise, and ECB the same. First time in 4 years after being, this is what I mean, is zero, inflation has ramped up back to target. Hence, one of their mandates is met. Do they need to now start hinting towards potential action in the future? Obviously, two names that you're probably familiar with, both of German descent, Jens Weidmann, Sabine Lautenschlager, who is another member of the executive board, likely to join forces on the hawkish side. So what you're looking out for today is the forecasts in particular. And Draghi's opening statement will include these new forecasts by regional central bankers for growth and inflation in the single area. And this is what in particular the market will be paying attention to. Major changes to the growth outlook are not expected. If you remember the Bank of England's quarterly inflation report that we had most recently, it wasn't the growth upward revision that we had that drew attention. It was the fact that they didn't revise up their inflation forecast, which actually caused sterling to fall quite dramatically on the back of the QIR. Same thing again here with the ECB. It's not so much the growth issue, which is what the market's concerned about, it's the inflation issue. German inflation, that's the real one that people have been worried about, because at 2.2%, German inflation is slightly higher than the rest of the Eurozone. And obviously, Germany already very vocal on the fact that they're anti the kind of QE forever stance. Looking at what a couple of the banks are saying today with the ECB, Goldman Sachs, they expect the ECB to raise its deposit rate no sooner than late 2019. Morgan Stanley, they predict the rate to be held at the current level of minus 0.4%. This is a deposit rate through next year, or this year and next year. Merrill Lynch sees an increase only after the central bank's asset purchase program has been phased out. So this is what you're looking at here with this graphic. So rates rise of almost 10 basis points priced for June of 2018. This is what we're looking at here. So you can see here, the blue line was back at the end of January, which is their last meeting. And this is where now we're looking at the markets priced at the moment for the next hike from the ECB. So you can see that prospects of a hike have increased, albeit we're not looking for a hike until June of 2018. But I did hear a very interesting snippet out of the chief economist of Soc Gen. So just quickly, basically an article I sent out to you guys this morning, and this chap is looking at the fact that obviously people look to the Fed as the precedent in toward the fact that the Fed had QE, they then tapered QE, then looked to raise rates. What this chap at Soc Gen is saying is that the Fed strategy was based on the view that quantitative easing was a mere continuation of standard policy by other means. And once the low interest rate bound had been reached, just as QE purchases had started in the US when the Fed funds rate had reached its bottom, the reverse sequencing was then implemented during the exit phase. However, unlike the Fed, the ECB has always stated that its non-standard measures are a complement to rather than a substitute for standard policy. In other words, interest rates can be adjusted both ways with non-standard measures still in place. So the ECB has cut rates, don't forget, twice after the beginning of the QE program. What he's basically saying then is that essentially, unlike the Fed, the ECB could hypothetically start to raise rates while keeping QE ongoing. It doesn't have to wait for then the tapering down of QE going forward, that to then finish, to then go into rate rising territory. It could hypothetically, given it's a negative 0.4, start moving that rate whilst keeping QE ongoing, which would obviously be very different from how the Fed have approached this. So very interesting to hear this type of commentary and people talking about these types of things at this point in time, particularly on the day of the ECB coming. The other thing is, another point that he makes is that removing sooner than later negative interest payments on ballooning stock of banks' excess reserves resulting from QE purchases would reduce the distortionary side effects. And by keeping a longer, albeit smaller, presence in the secondary bond markets, which is what their QE program is, the ECB would be in a better, more flexible position to prevent unwarranted spikes in the sovereign bond yield spreads within the euro area. If you think about it, there's two different things here you're trying to manage really from a broader sentiment point of view, with all the political unrest and what could happen with France, Netherlands, Germany at the end of the year and so on. What you do want to have in place is the QE program to potentially negate any spikes in those yields around these periods of political strife. However, that doesn't mean that you can't get the tightening phase, if you like, underway by instead focusing on the banks and liquidity and moving on the interest rate side instead. So just something to contemplate, which is a slightly alternative view from the broader market. One of the other things that Deutsche have said in general, and I think it sums it up quite nicely, is they said it's probably too early for the ECB to announce more tapering. Their economist baseline being that such a move is still 6 months away, with the possibility of an earlier announcement in June. However, they expect hints of a slow and gradual evolution to a less dovish policy stance today. Now, for those who are more experienced, it's all about the specific wordplay that Draghi uses. And for example, they could provide a less downbeat balance of risk to the economy, an adjustment to forward guidance to remove the option of reducing policy rates further, and or the removal of very from the statement, in that a very substantial degree of monetary accommodation is needed. Now, for the newer guys, that might sound very minor, but for those who've traded long enough, just the extraction of the word very substantially changes the connotation of that last sentence. A very substantial degree of monetary accommodation is needed. Just a dropping of that, I would say, is the first then subtle signal that we're starting to move out of that phase. So it's something to look out for certainly later on today. Okay, just to wrap up, quick look at the calendar. Nothing really coming out of great interest from this morning. ECB, two-part event as per usual. Nothing expected to change at 12:45. So that's likely to be a non-event, but definitely be tuned in at 1:30 when he starts commencing the press conference. That's the real highlight for the session today. So not expecting overall a great deal, but the forecasts might dictate the overall price movement with a particular focus on inflation and upward revisions to that. We've also got the regular US jobless data, but that's going to be pretty much brushed aside, to be honest, given how strong ADP was and the market's looking to head to NFP on the job front. Okay, guys, going to wrap it up there. So enjoy your session. I'll jump back on nearer the time to go over all the main events in more detail. Just as I'm talking, started to see that divergence again developing. I can see in euro, dollar and cable. This has been a pattern I'd say we've seen for the last week or so at least, with a bit of stabilisation on the French situation, comparative to some of the political uncertainty creeping back in with some of this latest toing and froing in the House of Lords and Commons on the Brexit bill. Keep an eye then on cable, still favouring directionally the short, given the more hawkish elements for the Fed. Expecting now forecast beating NFP report. Several big banks upgraded their calls yesterday, including likes of Goldman Sachs and other Wall Street banks. I think the deviation has only been minimal last 2 months between ADP and the BLS report. So you should be expecting a pretty solid number there. So ultimately then, dollar may be supported up until that point in the context of a weakening political environment and uncertainty in the UK. So still favouring that downside in cable for today's session. Okay guys, have a good one. See you in the chat room.